The World Bank is the latest global financial institution to warn of a global economic slowdown due to the conflict in the Middle East. On Thursday, the World Bank trimmed its global growth forecast for this year by 0.1 of a percentage point to 2.5%. But that's the best case scenario. It's warned the growth could slow sharply to just 1.3% if the Iran crisis drags on and the broader stress across financial markets is triggered. Well, developing economies are also slowing, with the bank expecting growth of 3.6% for those countries this year. It's the weakest pace since the pandemic and down from 4.4% in 2025. Well, the growth forecast in the Middle East has been cut from 4.3% to just 1.6%. In January, the United Arab Emirates was poised to grow 5% this year. But the World Bank now expects the oil-rich nation to grow just 2.4%. Well, Pushpin Singh is the managing economist at the Center for Economics and Business Research. Pushpin, great to have you on the show. So first of all, is this only the start of a more serious global economic downturn?
Well, the evidence rightly points to that, actually. I mean, you're starting to see a lot of data coming in. For example, the US with Q1, which includes the first full month of the conflict, it slowed down relative to Q4. The Eurozone correspondingly contracted. You've got high-frequency data as well, with the PMI showing a huge downtick since the onset of the conflict. Even within Asia Pacific, with China, the April data came out really wasn't the greatest of all. So the data supports the idea that we are starting to see a serious slowdown moving forward.
Well, the picture is rather gloomy, isn't it? And the World Bank report said the global growth could slow to just 1.3% if the financial markets are impacted. You probably wouldn't like these questions, but how likely is that?
It's very hard to say. I mean, with the financial markets, there are two key spheres that we'll have to look at. One is the idea of public finances, right? You're seeing all across, especially in Asia, which is the worst hit region due to the Middle East conflict. There are a lot of fuel handouts, a lot of temporary cuts in taxes, which are going to add to each of the economy's relative debt levels, which has already been strained due to the pandemic, due to the Russia-Ukraine crisis, and that's going to put a lot of pressure on their sovereign bonds. The second aspect is the more general financial market aspect. We mentioned, and you're going to see the idea of capital being drawn away from secondary markets into primary markets due to a lot of these tech IPOs that are coming up with Anthropic, OpenAI, and SpaceX. So that's going to lead to a liquidity crunch, which has the huge potential of causing a huge financial turmoil. So it's not ideal, but it's very uncertain in terms of how the dynamics are going to play out.
Yeah, exactly. It's very hard to tell at this point, and because the situation is rather fluid, isn't it? So what does this mean for central banks all around the world already struggling with inflation and weak growth?
You're right to point that out. That's basically the stagflationary environment which central banks really don't like to care. On one side, you want to promote GDP growth, so you'd want to cut interest rates, but on the side, you've got high inflation, which means that you've got to raise interest rates in terms of the economic mechanism. It really depends from central bank to central bank. If their mandate is for price stability, it probably means that rates are going to be higher for longer, and that has implications for both the consumers, the businesses, and more widely for the economy in terms of slower real activity.
Okay, thank you very much, Pushpin, and please stay with us, and later we'll go back to you to talk about the European Central Bank's interest rate decision. Well, the World Bank also cut growth expectations for the Eurozone from 1.4% to 0.8% this year. Here in Europe, the central bank has raised interest rates for the first time in 3 years. Policymakers voted to raise the ECB's key interest rate by 0.25 of a percentage point, bringing it to 2.25%. Well, inflation across the Eurozone reached 3.2% in May. Before the Iran conflict began in February, inflation had been below 2%, the ECB's target level. Well, several central banks around the world, including those in South Africa, Australia and Norway, have also raised interest rates since the conflict began. And next week, the US Federal Reserve and the Bank of Japan are expected to announce their interest rate decisions, and the ECB's move comes after the United States on Wednesday reported its highest inflation rate in 3 years.
You know what I really love? I love the inflation. You know why? Because as soon as this war is over, I can say it now, something you didn't know. Do you know we've been taking out millions of barrels of oil? Nobody knows it. You know who doesn't know about it? Iran, until right now.
And now let's go back to Pushpin Singh, Managing Economist at the Center for Economics and Business Research. Good to have you again. So was this the right call? I'm just wondering, is the ECB prioritizing inflation over economic growth?
Well, to even contextualize whether it's the right call, we have to look at the ECB's primary objective, which is for price stability. So if you take that into account, the ECB clearly thought that the surge in inflation in May to 3.2% was outside of its tolerance limits, and as such, they wanted to hike rates to kind of mitigate any kind of price pressures happening. So clearly, they were prioritizing their mandate to enforce price stability right now.
And what is the biggest risk for Europe's economy right now? The question is, because what is tricky here is it is a balancing act, isn't it? It's between fighting inflation and also growing the economy. The central bank raised the inflation forecast in the Eurozone. The number is average 3% in 2026 before coming down to 2% in 2028. So what is the biggest challenge now for Europe's economy?
I mean, is the biggest challenge, which has been prevalent for the last 12 to 18 months, essentially, is uncertainty, which is so hard to plan against. First, last year you had the whole kind of trade war and the tariffs being imposed in the Eurozone, and now you have, the Middle East conflict, which is something outside of the control of the Eurozone as well. So the biggest challenge for them is trying to kind of mitigate the impact of these uncertain events on their economy, on the consumers, on businesses, which is very much easier said than done. So Europe is going to, ECB including them, are going to try to best in terms of using policies to ensure that, the effects are kind of mitigated. But it's going to be a very hard road ahead for at least the next 12 months.
But I think for viewers watching from Europe right now is how will this affect households?
For households specifically, I mean, I think the effects are starting to be seen, right? If the inflation is surging up to 3.2% in May, it means that clearly the price levels increasing are starting to hit the household finances. The direct impact will be via energy, which you can see why the fuel prices are increasing massively, around, I think, about 10%. But there are going to be wider spillover impacts down the line, simply because of energy's role as an input into key production processes. What that means is the fact that the average kind of bundle of consumer goods, be it the food at the shops or your kind of services that you do over the weekend, are going to increase in cost as well as businesses try to kind of put some relief on their margins. So the overall bundle of consumer goods is going to increase in terms of cost, and that's going to weigh on household budgets. So that would mean quite a lot of kind of lower consumer spending in the meantime, as well as households look to save and try to find cost savings everywhere.
I think just one more question. The head of the ECB said we're not committing to a particular path, and she said that before, actually. What can we expect?
I mean, at least in terms of CBR's view, we are expecting another rate hike at some point this year. In terms of what the ECB chief said, they have kind of gone on a data-driven approach in terms of what's best based on the data that they have at that point. And it is, in our view, a right approach simply because of the uncertainty surrounding, the conflict. In 1 week you can have the conflict is about to be resolved soon, and in another week you can have a fresh wave of strikes again. So the situation is inherently fluid and dynamic, and it's very hard to even try to find a way to plan for it, which is why ECB is adopting a data-driven approach in terms of assessing the data at the point of the governing council meeting, and then from there making a decision. What this means is the fact that there's not going to be a lot of forward guidance, but clearly with today's rate hike, it is clear that the ECB have found that the inflation surge is intolerable for them to not raise rates. And we are expecting further rate hikes down the line.
All right, thank you very much for your insight. That is Pushpin Singh, Managing Economist at the Center for Economics and Business Research.